we're going to go through why is basis important. This is something that comes up in the financial exam as well as here on our regulation exam, something critically important no matter where you are in accounting. Now, calculating your basis is essential for several reasons. Some of these are going to be that we'll see in the exam. Some of them are kind of just more of an FYI, just for your context and understanding in the real world. The context of depreciation, that's going to be critically important. The sale of assets in the future, like stocks or houses, that's going to be important. This is a cornerstone lesson. This is for sure going to be built upon in other lessons. So make sure you understand this one. This is not going to be like a one-off thing. No, this is something you will see in many other lessons. The concept of basis in the holding period of assets. Starting off, why is basis important? Well, depreciation. Whether you're doing straight line depreciation for book purposes or maker's depreciation for tax purposes, that in and of itself is its own lesson, very important. For tangible assets, calculating an accurate tax basis will be necessary to determine your allowable depreciation deductions. You're going to first get your taxable base. You're going to understand what you need to depreciate each year, and that will then be your depreciation expense on your tax return. This is our way of allocating the cost of an asset over its useful life instead of taking the full deduction in this current year, because that's just not how accounting works. I could dive into that a million times over, but hey, we've also got a whole lesson on that, which helps businesses recover the cost of an asset and reduce their taxable income. Now, an accurate tax basis ensures that the depreciation deductions are calculated correctly, allowing businesses to take full advantage of the tax benefits involved with that and maintain compliance with tax regulations. Important for both saving money and for being compliant with the IRS. Now, capital gains and losses, when we go and sell an asset, whether that's stocks or a house or machinery, equipment, factory, warehouse, anything at all like that, when we sell or dispose of an asset, again, really could be anything, the tax basis is crucial in order to determine the capital gain or loss when that asset is sold. Capital gains and losses are calculated by comparing the sales proceeds with the asset's tax basis. I mean, that's pretty much your good old general formula. Again, what is your gain or loss on something? It is going to be what you received, your sales proceeds, minus the basis given up. We'll have lots of examples practicing calculating the basis, what costs go into the basis, the concept of capitalization versus expensing. If that's something you're familiar with, then we'll see that be applied here in this lesson as well. If not, we'll make you an expert at it and send you on your way so you can live happily ever after once you pass the exams. Now, accurately calculating this is going to help us to make sure that we are, again, compliant. Gotta love being compliant. I love being compliant. Being compliant is something that I take great pride in, and minimizing potential tax liabilities. Looking good, looking good. Let's look at some more reasons. All right, basis, step up or step down. Now, when we're talking about inheriting an asset in that many situations, gift tax, inheritance, stuff like that, the tax basis may be adjusted to the asset's fair market value at the time of transfer. So we're not going to dive into this too much as a concept here. We're just understanding the importance of it, that we will see this when we deal with inheriting assets, gifting assets, things such as that. This is going to be known as your step up or step down basis. And how do you know how to adjust the basis? Well, first you got to start with a basis in order to adjust it up or down. That's, again, critically important. Now, knowing the original tax basis and the adjusted basis, that's going to help the taxpayer properly calculate capital gains or losses when they later sell or dispose of the inherited asset. So you see, it's just going to be critically important. I mean, whether it's your basis in the partnership, your basis in an asset, this is a critical concept throughout the entire exam. Now, these other two, not really ones we're going to see on the exam, but important as well to understand overall the picture. Tax planning. Now, knowing your tax basis of an asset is going to help a taxpayer make informed decisions about their investments and tax strategies. Yeah, for sure. You plug this into a tax simulation calculator, kind of helps you figure out what you should be doing in the current year and in the future. Knowing this can help you decide which stocks to sell in order to optimize capital gains and losses. So very important for tax planning. But again, that's not really something we'll be tested on, just for your understanding. And then record keeping, just also understanding that we have the correct information for audits, tax disputes, other issues. Also to understand how well we're doing financially. And that might be more of a financial accounting concept, but just overall, the importance of the basis of an asset kind of delves into these concepts as well. All right, we've got different rules per the IRS, the IRC, for determining the basis and the holding period of various types of assets, including, again, the basis. This is essentially the initial cost, but also modified by things such as depreciation, add-ons, adjustments. We'll see all of those components. And then the holding period. How long are you holding the asset? Are you holding the asset for a year before you sell it, 3 years before you sell it? 2 weeks before you sell it, 6 months, that's going to have massive implications as well. Now, for stocks and securities, the basis of stocks and securities, bonds, anything like that, options, generally is the purchase price plus any transaction costs. Generally, for basis, what is going to be our depreciable base? It is the purchase price, or just generally speaking, for whether it's financial or tax, your base for anything is the purchase price minus the costs needed or necessary to get something ready for its intended use. So, for example, if you couldn't buy a stock or a security without paying a transaction cost, well, you're also going to capitalize that transaction cost and add it to its depreciable base. That's important to understand as well. Now, if we're talking about a machine or real property, let's see what we're going to deal with here. The basis of real property is generally the purchase price plus any transaction costs. Again, if you got to pay a lawyer to sign to get the contract ready, or you have to pay the state and pay down any taxes on the property, that would be something, improvements made to the property to make it safe and livable or usable. That's also going to be necessary for its intended use. I'll deal with the holding period in a second, but for depreciable assets, so the basis for depreciable assets, such as machinery or equipment, this is generally the purchase price plus transaction costs. We see, transaction costs a lot, and depreciation deductions taken. Now, the holding period, right? This is a holding period. Why is this important? Because, well, short-term capital gains and losses are treated differently than long-term, and the difference there being if it's 1 year versus more than 1 year. If I sell a stock only holding it 6 months, which is less than a year, I'm going to get less preferable tax treatment than if I held the stock for more than a year. And if you were not familiar, we have this definitely in our gains and losses lesson as well. But the importance of that is the IRS is kind of wanting to incentivize people to hold assets for more of a long term, creating stability in the market. So that's why we're incentivized to hold assets for a longer period of time. Now, the holding period for stocks and securities, that's generally determined by the date of purchase and sale. So if I buy a stock today, sell it exactly 1 year later, then that's going to be a long-term capital gain. Pretty straightforward. The basis, the holding period for real property, again, kind of the date of acquisition and sale. That's important there. And then really, again, placed in service and the date of sale or disposition. So the difference here for depreciable assets is something like a depreciable asset, like a piece of machinery. We may dispose of it, throw it away, it doesn't work anymore. We may sell it before it's fully depreciated. And this placed in service date, so we've got a machine, and cool, awesome, it's going to start pumping out products for us to sell. That's great, that's awesome, that's wonderful. However, what are we talking about? Are we going to put that into service as soon as we buy it and leave it sitting in the box? No, we're going to actually start considering this used once it's placed in service. So if I buy that machine, it's sitting in the box, and then 6 months later, I set it up to start using it. We're going to use that placed in service date rather than the purchase date. So that's the big difference there, and understanding, well, that makes sense, right? We're not going to want to use the date until we actually start using our machine, because at that point it's considered in use. It's actually doing what it's intended to do. And that's pretty much what we got there for these types of assets. Understanding the differences. Again, we will see lots of examples, making sure that we are practicing every opportunity we get. Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.